Hey everyone, welcome back to another Unqualified Opinions from Messari. I'm your host Ryan Selkis at 2-Bit Idiots. Really excited today to have Chris Burniske, co-founder and partner at Placeholder VC, with us to talk about a lot of things. We're going to pierce the veil and try to make sense of things like crypto valuation, whether anything is rationally priced in this market. We'll touch on governance a little bit. And we will talk about the smart contract wars and some of the coming sell-side pressure that mainstream investors can expect from this sea of SAFs and private placements that are ultimately going to get liquidity over the course of the next 18 months. And there's a number of different directions we can go from there, but
many rabbit holes.
Yeah, many rabbit holes that we can go down. But Chris and I have known each other for about 5 years now. And was one of the earliest. He was one of the earliest research analysts to actually put forward a full enterprise or institutional investment thesis for the asset class. It was the dawn of the new asset class. Was that the name of it?
Ringing the bell.
Ringing the bell. And it was co-published. It was co-published with Coinbase and Adam White. And this was back when you were at ARK Invest. Why don't we just start there? Let's talk a little bit about your start in the industry, how you got sucked in, and just your trajectory and acceleration from a relatively young analyst to one that is now running one of the largest crypto venture funds, and just how wild a ride that's been.
It has been a wild ride. We have been on a wild ride.
Wrote a book, so.
I actually remember the first time we met. It was I think late 2014. We were at Second Market. What was then Second Market's office. It was you, me, and Barry. I remember I was a young kid. I wasn't even 6 months into New York City. I was learning everything about finance. Really, I studied ocean systems in undergrad. And that was biochem and physics all around the ocean because I wanted to work around the ocean because then I would be living near the ocean and then I could surf every day. Life took a wild turn, as it tends to. But I specifically remember that meeting because I felt like such a kid. And I remember, I think they had hyped up, or Second Market or whoever it was, maybe it was Grayscale, had hyped up, there's this Wall Street analyst coming in from the buy side and he's going to do a report on Bitcoin. And I remember we met, and you were just like, "You're such a kid."
I don't think I used those exact words.
You didn't use those exact words.
But I remember going through kind of section by section, and it was, there was some harsh feedback. Probably it was like, "This is wrong. This is just wrong. This is not really." And I don't understand this section. And then, to your credit, you came back like a few weeks later, and it was like a 10x improvement, and a kind of every step along the way.
Well, you gave me a lot of really good feedback. Yeah. I didn't mean it to be a slight in the least because
it's very on brand.
It was super valuable for me, and that was how in the early days we learned about Bitcoin. It's really going saying I understand this, but I don't understand this, and so that whole progression, it culminated in ARK becoming the first public fund manager to give its investors Bitcoin exposure. We got really fortunate with timing there. We did that September, October, November of 2015. Shortly thereafter, BTC doubled from the low 200s to the low 400s. And here ARK was the only public funds with BTC exposure. So that started to kick off a lot of media interest. I met Jack Tater, who I ultimately co-authored Crypto Assets with at Consensus 2016 it was. I think it was 2016. We started writing the book that fall. But at that time, so Consensus 2016, I remember the DAO was like starting to percolate. And that summer, the DAO got really big. Ethereum rallied into that. But then when the DAO blew up, Ethereum crashed. End of 16, ETH was beneath $10. And so we were just kind of writing kind of in a languishing crypto market. We didn't expect 2017 to necessarily be what it was. I don't think anyone in the industry expected that. Because it felt like an order of magnitude more than what 2013 was. And you experienced 2013 more than I did. I kind of got like the aftermath, kind of after a plane goes up and lands, all that turbulence that I experienced in 2014. But then, published the book in the back half of 2017, and it was really interesting to see how much interest there was in crypto. It was an overwhelming amount of interest. And end of 2017 is when myself, Joel Monegro, and Brad Burnham got Placeholder off the ground and raised a 9-figure institutional-only fund at the time, which felt like a big deal. We tend to be overstated or understated with our PR, other than my loud Twitter handle, I guess.
As loud as you can be.
As loud as I can be. I try to work more than I talk, but still a voice. And here we are, over halfway into Placeholder's first fund, feeling really good about the portfolio and feeling really good about crypto.
And so a couple of things to unpack there. So you started writing the book. Were you at that point planning to get onto the next gig, or was this just something you were going to do as a side project with ARC? When did the ambition start, the funds really kick into high gear?
Kicked into high gear fall of 2016 because Joel and I were becoming close friends. So I met Joel start of 2016 at a conference at NYU, just a single day conference that had like Peter Todd, Joe Lubin was there, I think Vitalik piped in. It was a 50-person conference. It was maybe the best single day conference I've been to in crypto. But Joel spoke. I was like, wow, this guy's brilliant. I want to talk with him. I was too shy to speak with him actually, but when I published the new asset class white paper that was with Coinbase, which was a portfolio company in USDs, and so I reached out to Joel and we had coffee the next day, and the friendship just kept going from there. And then I remember USB was diligencing Polychain towards the end of 2016, so I was talking with Joel a lot about that deal, and it really led us to investigate, well, what's the best way to run a fund in crypto? And we just through that theory or investigation, we came down to, well, we would want a venture fund or a venture structure, and we can get into the differences if you'd like, but a venture structure or a hedge fund structure. And so, one thing led to the next, and pretty shortly thereafter, early 2017, we were like, well, why don't we run a venture fund? And Joel's mentor is Brad Burnham, who founded USD with Brett Wilson. My mentor is Kathy Wood, who founded ARC. We talked with Brad and Kathy. They both gave us their blessing. And so really, spring of 17, we were starting to work towards it. Officially left ARC June, July. And then Placeholder was incorporated coincidentally on the day Bitcoin forked, Bitcoin Cash. So August 1st, 2017, Placeholder incorporated, and then it took us a half year to raise our first fund. And we were in business deploying capital started 2018.
So we can maybe talk a little bit more about fund structures in a minute, right? Because I think the different fund structures and kind of the nuance of how different firms are thinking about entering and exiting deals really matters once we start talking about price discovery and valuation.
Yep.
So you sent over some notes. First of all, maybe one of the only guests that sent over notes, which is kind of par for the course and kind of in line with my expectations. But there was one thing you highlighted, which I think is a good jumping off point, and I haven't really heard it discussed this way, which is just capitalization methods in the spectrum of capital to labor.
Yep.
So, my understanding of this, and I want you to kind of drill down and give us your mental model, but basically, are you providing work to the network and then getting a return, or are you providing capital as a venture fund or as an ICO investor and then expecting a return? And that is probably going to lead to two very different sets of incentives for the participants in the network, and sets of behaviors, and maybe even like cultural differences between these protocols. So let's unpack that a little bit, because until we have that as a starting point, it's really tough to talk about relative valuation and pricing and fair value.
Yes. Okay, let's do it. Forgive me if I go on a monologue, or interrupt me at any point. But if we rewind in time to the birth of the idea of a joint stock equity company, right? that was really a means to raise capital, to go on a long-term journey, merchant journeys at the time, the Dutch, to go on a journey which would require a lot of labor, right? So you're raising capital to pay the labor, also to buy, to spend the capex on the boat and all this stuff. Go get a bunch of riches from foreign lands and bring them back and hopefully make more money than was put into it. But there was a good balance of capital and labor. Now, over time, with software and with inequities, you still need a lot of capital, but once you're up at scale within software, you can produce each incremental unit at zero marginal cost.
Mm-hmm.
And so the returns to capital are becoming greater and greater and greater, because once you get the system set up, you're just printing money with each new unit of software sold or whatever it may be. And so there's this imbalance that is popping up, in my opinion, in equities where shareholders, the capital holders in equities, are getting too much of the profits, right? And so that is ideally something that we can fix within crypto. Now, a crypto network is also capitalized, and it's capitalized, as you said, along the spectrum of capital and labor. And if we go and we look at something like BTC won a lot of goodwill early on because it was really just labor that allowed you to earn BTC. Because this is the hobbyist days, right? Mining on CPUs, you could have had this laptop here, and it would slow it down a bit, but running in the background, earning yourself BTC. A bit of capital in there, but mostly labor. BTC over time, I would say, has trended towards being capital intensive, right? As it's industrialized its mining base, and it takes more and more capital to actually buy the machines and run those situations to earn the BTC. But we'll come back to this with price discovery. There is a cost structure that forces selling of BTC over time. And so I think of BTC is quite a good balance of capital and labor. Ethereum was slightly different in that they raised capital up front, right? At the time that caused uproar. It was a scam, and they're taking people's money. But really that was kind of a very traditional, we're going to raise capital to build the software. We're not going to raise too much capital. I mean, they still raised a lot for the time. But in 2017 terms, they raised relatively little. But that was capital up front, and then you had labor once the network launched, again, earning the asset. Again, balance. In 2017, I think we fell out of balance, right? Ethereum was such an effective financing platform that made it so easy to capitalize a crypto network purely with capital that people went bonkers with capital. Now, the problem is, when you just capitalize with capital, you get a lot of ill will from the community because capital tends to be concentrated, at least in our current form of capitalism. And you also have very little cost structure in terms of the people actually supporting the networks. And so this is where we transition into price discovery, where I see a lot of the networks, or at least what I'm expecting, networks that purely capitalize with capital. So there's a lot of the big ICOs, especially the high-flying ICOs, where they purely capitalize with capital, and then were kind of closed collaboration mechanisms. They didn't allow much external labor input. When they list at these really high prices with high expectations, they're trending down, right? Like if you look at these charts, they're trending down. They're trying to find their cost within a commodity theory. You trend down until your marginal cost of production. And that's where we potentially get into a really problematic arena for some of these assets that have very little cost to produce because they have very few laborers. They're not sent. You can make the argument that this will all improve over time, but what I'm seeing is if you set your expectations too high with a really high market price, and really your cost was just the capital that went into it, but you're trying to mark things up really high, the market kind of sniffs that out and may in some cases trend back to the cost of the original capital. That is so different from the charts of BTC, ETH, or a lot of these networks that included a lot of labor, included a lot of external inputs, where they start super low expectations. You're just earning. BTC didn't have a market price for 2 years. and they're trending up. And as they trend up, the laborers have cost structures that require them to sell. Whereas in an ICO, you have capital, there's the time value of money, but it doesn't force selling the way when you start and you're trending up, as Ethereum and BTC have, and you're creating, it's this really organic price discovery where you hit new levels, those become support, you hang out, you consolidate, you hit new levels, as the utility of the network goes up, as the holders go up, all these things. And so, I just kind of had this aha around, okay, and to some people it might be an obvious thing, but you can't fool the market, right? If you just capitalize with capital and you allow very little labor, very little work, very little cost to go into your network before launch, to the market, it might trend down in cost, and that is so different from the organic rise of starting low and building out with capital and labor over time.
So first of all, I couldn't agree more. I've always thought about this slightly differently, or at least use different words, but I think that the same theory is in play. And that is to distinguish some of these communities between those that have missionaries and those that have mercenaries. Right? So if you're thinking about starting a company, you want to find the other misfits that are going to come in the room and bootstrap with you on some crazy idea, and then you capitalize, later.
Yeah.
Versus raising a ton of money up front and then just hiring kind of the best available people at market rates. You're going to have a fundamentally different culture.
Yes.
And I would argue one that is weaker at the core. I think this becomes an order or orders of magnitude more important when you're talking about a monetary premium. Because other than a monetary premium, there's almost no fundamental valuation drivers.
We'll come back to that one.
I will argue, and then we can debate this back and forth. But there's almost no real network activity or fundamental value drivers for some of these networks that do not have a monetary premium, right? So if you're going to create money, you need the origin story, you need kind of the mysticism about the project. And even though Ethereum was an ICO, I think Vitalik is such a singular, unique figure in that community. It almost has like a little bit of mysticism around the world computer and the decentralized everything, and it's kind of backed into becoming money.
Well, there's so much labor, like it's been 4 years,
Exactly.
over 4 years since Ethereum launched, and so much labor, blood, sweat, and tears have gone into that network for 4 years now.
And I think that only happens with someone like Vitalik as the benevolent leader. Whether you say he's in charge of everything or not, we know that he doesn't actually control the protocol anymore. But his ethos kind of set the tone.
Yes.
And created that culture of missionaries
Yes.
that allowed that to flourish. I don't see that in other networks right now.
Yeah, not as many. And this is where Bitcoin and Ether, I think, long run, we will look back and view them as very similar. And quite different from a lot of these more next generation smart contract platforms. Because I definitely agree that Vitalik has done a good job, Vitalik and his crew, with Gavin as well, of creating the cult of Ethereum, just like there's the cult of Bitcoin. And this is maybe a more philosophical thing, but I very deeply believe that we only value the things that we work for. And so this is a common problem if you're born into a wealthy family. If you have all the wealth in the world, you may not actually value it, you may not be inspired to work for it, you may not be inspired to work for anything, so you can end up very depressed and not valuing anything. On the opposite side of things, if you start out from a lower base and really work for things, you relish every victory that you have. And when I look back at Ethereum's early days, it was dicey. The foundation almost ran out of money, right? Because they raised in the middle of 14, they raised in BTC, BTC kept falling, foundation ran into cash problems. People were not there to get rich. People were there, they were idealists, they were working their asses off. And because of that, they came to love Ethereum, just as the Bitcoin community did similar things and came to love Bitcoin. I would say with the ICO boom, a lot of people got dollar signs in their eyes, but you can't buy love, right? You can't buy commitment.
We're getting very meta.
We're getting meta. This is maybe a side of me that I keep offline more. But yeah, I think you're absolutely right that we're not seeing, and it's not to make blanket statements. There are really good networks out there other than Bitcoin and Ethereum, but those two are definitely the most robust communities because they've earned it.
Mm-hmm. So let's talk about price discovery more generally speaking. So Bitcoin and Ethereum, I think most people would acknowledge that there are these peaks and valleys, but generally it's healthy because there's this stepwise function where people get way ahead of themselves with what could be possible with these technologies and assets. Things come crashing down, but during those peaks, it's basically the best recruiting tool that the industry has, organic recruiting tool, because then you see the bull market brings in another wave of folks that build during the bear market and the consolidation, and then there's another rally. At least that's the way that it's been for basically 3 or 4 cycles now. And every single time the cycle is very different in terms of the audience that is attracted. At first it was the hardcore market capitalists, then it was more tinkerers and gold bugs and more mainstream libertarians. In the last cycle, we started to see kind of misfits from Wall Street come in, right?
Well, Wall Street's also facing its own problems.
I think I'd include myself maybe in that general cohort, and you if you want to join. And I think with some of the institutional tools that are being built now, there's kind of a bifurcation of there's a professionalization around the Bitcoin ecosystem, and then there's still this like wild west of everything else. So Ethereum's kind of middle ground, maybe between the ICO market because it was the first ICO in some ways, and Bitcoin, and a fair launch, proof of work type system. But how do you think about price discovery for some of these assets that have just started with an enormous amount of capital thrown up front, and now we're going to have to slowly distribute these token supplies over time? In some cases, the team doesn't even necessarily have control over the pace of that distribution.
Yeah, or they have too much control.
Mm-hmm.
So this is going to be really tricky. And for what it's worth, Placeholder did not invest in a single, say, brand name smart contract platform pre-launch competitor. In terms of smart contract stuff, we have Ethereum and Polkadot. And Polkadot, I don't even think of as directly a smart contract platform competitor. It can be, but it can be other things. So we stayed out of the Definities, hash graphs, and the high flyers, not because we had the theory that I'm going to put forth all worked out, but Brad was often like, these are really pricey, should we wait until they list to see what the price action is then, which was interesting because we're a venture firm, right, and Brad's a 30-year venture capitalist, but his intuition there was really interesting. These teams didn't really need us as an investor. They had all the money and investors that they needed. So anyway, we stayed out, and right now I feel good about that. I'm not here to try and engage in Schadenfreude. How do you say that word?
Schadenfreude?
Schadenfreude. There we go.
I just said it with more authority. So I have no idea if that's actually right.
But so what I think might happen with some of these teams that have a lot of capital, and especially the layer ones that are just launching now, and we have a whole roster of them for Q4 and into Q1 of 2020, is if they come out and they're quite inflationary, but they also have super high throughput in their block space. And this has been, a selling card for these platforms to raise money. We're super high throughput, we can reach Visa scale, there's no clogging, et cetera, et cetera. The thing is, and this was reinforced to me when I was looking at doing a demo with a staking platform recently, all of the earnings to the supply siders, the laborers at that point, are just inflation earnings. But the actual transaction fees are super low. I mean, I was on a platform looking at them participating in a few different networks, and we're talking transaction fees were 1 to 10 basis points of inflation fees. So less than 1% of inflation fees. And I think, Ethereum's like around 7% right now. I don't know what BTC is, but with Ethereum and BTC, we are seeing transaction fees rise, take share from inflation rewards. And that should happen over time. For Bitcoin, it eventually has to be 100% transaction fees. what am I getting at? What I'm getting at with the new smart contract platforms is if they're too high throughput, there's actually no scarcity in the blocks or the DAG or whatever the structure is. And if there's no scarcity, then there's very little incentive to pay high fees or fees at all for submitting a transaction. And so then what you might end up having is you're just having inflation with no one paying for the economic value of the network, right? And if we look at transaction fees, or we say transaction fees are people paying to use this network as the growth of the economy, if that is not growing, then any inflation is not really being dampened by growing use, right? Like if you think about monetary policy, you will experience price inflation if you are inflating faster than the economy is growing. This is the MV equals PQ. So what we're talking about is really high inflation while potentially the transaction fee economy for these networks isn't growing. And so if you lose consumer confidence or market confidence because they're like, well, transaction fees or earnings aside from inflation are never going to go up because they're too high throughput, then you could have some pretty vicious downward spirals. I don't think that this is doomsday for all the platforms. I think a lot of them will sell off for a period and find a bottom, and we're seeing that in some of the ones that launched already. And then it could be a few years of building, of really getting people to build at-scale applications. I think that the benefit, so while it could be a lot of pain for the next-gen smart contract platforms for the next year or two, or three, I think what's good about that actually is it will collapse the cost of building and running decentralized applications, right? And that should open up our innovation sort of ecosystem, because when you collapse the cost, you make it more accessible to more people, right? So short to medium term pain, likely long term gain, and we'll see how Ethereum ends up reacting ultimately to the smart contract platform competitors. But again, short to medium term, I think the economics are potentially dicey.
And I think this might be where you and I disagree a little bit, and we've had this conversation offline in the past. But I want you to correct me if I'm wrong, or if your thinking on this has changed. So I remember it was you, me, Steve McKean, one other person was on that call with Lou, right? This was back in like 2017 about like fundamental value drivers for the economy.
Oh, this was a webinar.
Yeah, and you'd gone through your model that was in crypto assets. And I disagreed at the time, and I still believe this pretty strongly, that you basically only got three types of assets. You've got monetary assets, you've got security tokens, which don't really exist yet, or security-like instruments that will have some intrinsic value that you can price according to traditional valuation frameworks. And then you've got this kind of middle tier of protocols where you have to be securing either network fees, which you touched on, or some type of scarce digital resource like bandwidth or file storage or compute or whatever. But unless there's something...
Transaction fees, but you still pay transaction fees for those resources.
Sure, right? So I put that kind of in one bucket. But like securities, there's still something underneath them that you can value, right? Yeah. So on the one hand, you've got these monetary assets that are priced. On the other, you've got all the other assets that you need to think about, like what a valuation would look like, other than greater fool theory. Where does MVPQ come in? And I know you wrote a post about how some of your thinking had changed with that original model. So maybe talk about the original model and how you thought about tokens, and then what levers, if any, changed that you outlined earlier this year, and if that's kind of the latest in your thinking.
No, that's great. Well, let's go to say the current state of thinking and sleeve in MV equals PQ.
And let's just define MVPQ.
Okay. So to start, I think the premise I operate under is all of the world's assets, existing and to be created, will someday be created, custodied, and transferred on blockchains if they are truly the lowest cost means to create, custody, or transfer. And so we're dealing with the whole world of assets. And so what I did this spring is I actually went back to a paper that I used with the Bitcoin Ring and the New Asset Class paper, a paper by Robert Greer called What is an Asset Class Anyway? And in that paper, he talks about 3 super classes of assets. There are capital assets, which are income producing assets of some kind. So securities, income producing real estate, these kinds of things, bonds. Then, and those capital assets, you're basically taking the present value of their future cash flows. And there are different ways to do that, but that's the basic premise. Then there are consumable transformable assets, which are more your traditional commodities, but also, for example, gold has consumable transformable use cases. It's not off-putting a value flow, but it is providing directly consumable or transformable utility into other things. So that's the second superclass bucket. Third superclass bucket is store value assets. Store value assets don't produce value flows like capital assets and don't really have consumable transformable uses beyond just being a store value. So, fine art is a classic example, or a luxury vehicle that's never driven, or these kinds of things. Gold also falls into that bucket. And so this is where we see gold as an interesting example of an asset that falls across consumable, transformable, and store value. Okay, with that setup,
and I'd say that framework is more or less consistent with my own.
It is. So we've come full circle, and might be using slightly different words. But when I
further evidence that I do not have original thoughts.
Well, we can make the argument that none of us have original thoughts. They're all just combinations of prior thoughts with a little, fairy dust. So most crypto assets actually, and certainly any crypto asset that requires staking in order to earn value flows, in order to be a supply sider, is partially a capital asset. And so part of that valuation will be the net present value of value flows to supply siders. And that's where it's quite similar to an equity in that holding the equity gives you access to the value flows. What's different with a crypto asset is you have to hold the asset and you have to work, right? Which I actually think is a better model. Because you have to work, you still have to earn it, and then you're getting value flows. But you can say that's the net present value of future value flows. I would argue the majority of crypto assets are going to end up in that realm, and whether we want to call them securities or not is a different conversation. But from a valuation perspective, capital assets are exploding in crypto as staking is exploding. Bitcoin is actually a very different beast, right? Because Bitcoin, holding BTC does not give me a claim to any value flow or governance rights or anything else. BTC is very much a consumable, transformable that overlaps with store value, pretty much exactly like gold. And so what's fascinating is no one's really figured out how to value gold on it. There's a bunch of theories, but it's not nearly as mathematical or concrete, in my opinion, as NPV of cash flows. And so this is where I think actually our best bet for the consumable transformables is MV equals PQ, the equation of exchange. So that equation, you have M, the monetary base, multiplied by V, the velocity. That shows you the turnover of money in an economy, typically in a year. That equals PQ. P is, say, the price of goods or services, and Q is the quantity of goods and services. And you can think of these two sides of the equation. MV is really the demand side, people paying and the money circulating, for the supply side, the goods and services that an economy produces. And so what I did in 2017, which was just a simple thing that turned out to be very contentious, was divide PQ, the size of the economy, by the velocity of the asset to solve for what M, the monetary base of a crypto asset, could be in the future. And you do this for all future years, and there's hash CIB, has really taken this theory and to its endpoint mathematically and done a much better job with it than I did originally. But the basic premise holds, and so I think that we end up having a pretty big bifurcation between capital assets and consumable transformables that slip into being stores of value. I think we'll only have a handful of those consumable transformable store of value assets that really the store of value is the monetary premium, right? So Bitcoin and Ethereum, very credible plays on that. We've also invested in Decred and Zcash, also deeming those to have very credible plays on that idea. When Ethereum switches to proof of stake, it's going to also become a capital asset. And you could argue that Decred also has capital asset components because it already has staking. And so this is where we could see an asset span capital asset, consumable, transformable, and store of value in a way that we just haven't seen with asset classes before. It makes sense that it happened in crypto because this is programmable value. We can do whatever we want. We have so much more flexibility than we do in the meat space world.
Do you think about all of these proof of stake systems whose rewards, quote unquote, are almost entirely inflation rewards and no actual transaction fees?
Yeah.
Can you still think about those as capital assets? 'Cause it's like running in place, right? So if you were just to perpetually issue stock dividends to your shareholders, it would probably be a huge pain in the ass from them from a tax and reporting standpoint and just kind of back office standpoint. But it doesn't change the market value of the company.
It doesn't,
right? So how do you reconcile the difference between, I think, the intention of some of the proof of stake systems to just siphon supply out of the market when it's not being deployed or spent, and the reality that you're not really earning income, right? It's not a true capital asset in the sense that you're earning income. You're not losing your principal or having that diluted down from non-participation.
So this is a great point, super important. This is where it goes back to the price discovery and some of the capitalization conversation. This is where inflation, as you said, does not grow the market cap of a company, and nor should it grow the network value of a crypto network. It may right now, because the crypto markets are still becoming efficient, but like if you look at Zcash, for example, network value has been much more stable than the token price has, and that makes sense because as it inflates its supply, if it's providing equal utility to the world, then the network value should stay flatter. Inflation is a redistribution mechanism, not the value creation mechanism. And so that is a really important point to understand. And this is where my kind of, oh my God, when I was doing the staking demo, if people are not paying transaction fees to use these networks, you cannot use inflation as a reliable tool. You'll actually descend into hyperinflation if you actually try and print more of your assets to give more money to your supply siders. It will be a mess. And maximalists, BTC maximalists, I think are going to be vindicated by a few big blow-ups in the proof of stake world. Now, I think if you do proof of stake the right way, and Ethereum and Polkadot and a few of these others, I think will give us these examples where, Polkadot and Ethereum are going to approach it quite differently. But if you are using proof of stake inflation as a redistribution mechanism while people are paying a lot in transaction fees, and if you look at Ethereum's transaction fees are reaching almost on par with Bitcoin's transaction fees, which for me is mind-blowing, right? That's a big deal. Those transaction fees are the value flows to the supply siders, right? And so that is the capital asset component in the valuation is really transaction fees. And this is why I was kind of like, oh my God, if these networks aren't going to actually have transaction fees, then the token in a pure proof of stake system is theoretically worth zero. And inflation is not a tool you can use.
So let's bring it back to reality a little bit, because we I think had an important theoretical discussion, right? How should these things be valued?
Yeah.
We know from 2017 and even today that most of these assets are not reasonably valued, and the market is not sophisticated enough maybe for individuals to properly understand exactly what they're buying and what their
Quick thing there.
Go ahead.
Quick thing there.
I don't believe the market's efficient. You're not going to.
No, I'm not going to argue that. But I am going to argue that early stage innovation, and this comes from my public market background, working at ARC, where we invested in the highest growth publicly traded companies that we really possibly could. Early stage innovation always gets priced at a fancy multiple. So high price to sales, high PE or no PE. Crypto assets don't necessarily have price to sales or PE. The security tokens will. But despite that, they are trading at fancy multiples. These multiples are going to emerge over time, things like the NBT ratio or NBTV, or there's all kinds of things. But I think what we'll see in retrospect is they were trading at really high multiples. That actually makes sense to me. Because the market, early stage innovation has all these expectations about the future, and so it's giving you a lot of capital up front to experiment. You don't want to take too much capital for all the reasons we just discussed, but it's really the market's gift of saying go experiment. And yes, investors are going to lose, risk capital is going to lose money on some of those experiments and make a lot of money on other ones. But the whole point is to go experiment. And this is where I get really frustrated with the tribal wars of crypto and the infighting. It's like, it doesn't matter. Like, the point of what the market is giving us right now is capital to go experiment. So that was just a little rant. You would go somewhere else.
So is there too much capital, right, is one question. And how do you think about the market dynamics in the next 12 to 18 months, specifically when it comes to the founders and the early investors, almost all of whom at this point are professional venture funds? What happens when you see more mainnet launches and some of these fiduciaries have to think about unwinding at least portions of their positions? And it's kind of the Wild West of lockups. There's no green shoe period. There's no.
Well, Messari will help provide a lot of transparency to this market.
This is one of the reasons that we exist. Yes,
you're going to have an exciting 12 to 18 months.
But the teams that are engaging with us are probably not the ones that are the riskiest right now, right? In that regard. So how do you think about it? Not in a kind of an ethical sense, and maybe the answer will include this, but just as a fund manager that has basically two competing sets of priorities. One, to invest for the long term because you are structured as a venture fund, and two, to make sure that you're making money on behalf of your limited partners. And it might very well make sense to sell as fast as possible out of some of these early stage positions as soon as they become public if the market value is great. So how do you reconcile those two things? And how do you think about the alternative case where there could very well be a rush to the exits? And if you're kind of higher on the preference totem pole, or you were invested earlier, right, and you're up 10x, but you know that the folks that came in after you are basically break even. Well, they're kind of shit out of luck along with any of the retail investors that start playing around with this as soon as they become liquid. So just talk about those dynamics and how you manage those relationships with the teams that you invest in or the communities, and then what you think ultimately happens in terms of less from an investment standpoint, because I think I know the answer, but from a community development standpoint. Are some of these things dead on arrival because they raised too much at too high values too early?
Yeah. So I don't think they're necessarily dead on arrival, but I think they're gonna go through a lot of pain. And theoretically, if they fall back to cost, it's the cost of capital, which was the original raise amount, plus some time value of money, plus whatever labor the core or team put in. So maybe it's a 2x from the amount of capital they raised. But a lot of them are going to come out trying to list at 10x or greater than the amount of capital raised. And so I think you will see a race to the bottom. I mean, I know for a fact networks are experiencing races to the bottom. It's just game theory. And this is where different fund structures are gonna come into effect. In 2017, we saw a lot of people go for hot money. If you got hot money in, hot money will be hot to get out. And so, I can speak from Placeholder's perspective of what we're going to do. And again, the only sort of high-profile pre-network launch investment we've made is Polkadot. And I can go into the specifics of the really smart things I think Polkadot is doing with Kasama and actually including a network and already getting labor, participating in all these things, which is part of the reason we made the investment. But so Polkadot will be our experiment in this. All our other investments, we really work with our teams to raise as little capital as you need up front, because capital is dilution and each capital raise sets higher expectations. So keep expectations low, raise the capital you need as you need it, and build from the bottom up. So that's kind of been our theory with our teams all along. So I'll be mostly a observer, I guess, in what's going to happen. And I think that as I just went through, some of them may come back to cost. Some of these networks might be, I can tell you from a market participant angle, even some of our ICO investments or teams where they started just launching straight out of capital, those markets are ghost towns compared to the organically mined markets, because there's just not all this richness that's built. But for some of these smart contract platforms, they also may be ghost towns, not just in the market, but in terms of actual use. So Alex Evans, Placeholder's crypto economics resident, has this great analogy, and hopefully he'll write a blog about it, of in China and some other countries, they built these immaculate cities, right? Cities with the latest and greatest everything, pre-planned cities, much better than all the old cities, and they're ghost towns. No one lives there. No community was built there. There's no emotional attachment. There's nothing. It was all pre-planned, all set forth. And so I always think of myself as a monkey, and all of us as monkeys, because technically we're glorified chimpanzees or whatever, but we are animals in that way. And so if we don't feel connection to these things or a place of belonging, then we don't go hang out in those places. And so I think you might see that for some of these launches. And this is where I think that a lot of teams, high-flying teams in 2017 focus too much on the technology, and maybe this is a Silicon Valley thing, focus way too much on the technology and way too little on the financial and social components. And for me, crypto networks that succeed are going to have to nail the financial and social components. Yes, you need technology, but technology is table stakes. This is all open source. It's all going to be commodity technology game. The differentiator are the financials and social, and you could make the argument that it's just really technology and social because the financial components are a derivative of the social component.
Let's talk about something related to that, which you can speak at a macro level, to talk about the workings of Placeholder if it's sensitive. How are you generally seeing investors mark their private books? Because this is a topic of a lot of conversation, and by the way, not just necessarily with pre-launch assets, but with assets that are in the market that are just very thinly traded. So what is the calculus that you do there? Are there specialized valuation firms cropping up? How do you kind of take a principled position on what the fair value these assets are given the survival of many of these funds? Maybe you to a lesser extent, given the 10-year structure of the fund, but certainly some of the hedge funds where they can face redemptions. This is a very real conversation that is going to ultimately impact the survival of some of the funds that
Super real.
are currently out there, and some of which are very high profile.
Yeah. As with a lot of things, it all comes back to incentives. So what Placeholder does, we mark all of our private investments at cost. Exactly what we paid is what we mark them at. For our positions in the liquid assets, if we have a large position in what has become an illiquid asset, we will discount it. We've discounted as high as 50% from market, because I just know if I have to exit that position, I am going to collapse the market. And those might be things that we never sell. If the network, if the thesis doesn't pan out, and this is where a VC has to be comfortable with some things, or actually the majority of things, being zeros. I'm not the vilified VC on Twitter that's out there to dump on retail. I'm here to capitalize things that work, that make society a little bit of a better place for everyone, and I will sell at a profit if I feel I have done that. So that's Placeholder. Now, Placeholder is a venture capital firm where our annual management fees are taken as a percent of the capital we raise. So we raised $150 million. That is very stable. Year after year after year, we get that. And that's by design, right? Venture capital firms are meant to invest. We are the venturing in first as capital into these things. And so because that is so risky, the structure has evolved over time to provide stability and certainty, both for ourselves, but also for our teams. We're never going to be facing redemption. We're never going to be selling out of our teams, of our assets, when they can least afford it, because everyone's in a bear market, because we set up the structure from the beginning. Hedge funds have a lot of variety in their structures, but they tend to take their annual management fees as a percent of assets under management. And this is where your incentive is to keep your book as high as possible, because then you can take the management fee off of that. Now that sets high expectations, right? And then you have to live with those high expectations. I personally am a person that likes keeping expectations as low as possible. I grew up in Hawaii. It's kind of got this humble culture where you don't go around and beat your chest, though I found myself occasionally beating my chest on Twitter and regretting it. But start low, keep expectations low, and then if you do a great job, say it then when it's realized.
We've got a fire alarm for this is the first, but it was just a matter of time before we got some major interruption. So stand by, we'll edit this out in post-production, and we'll flow right back through.
They should reimburse you. They just stole like 20 seconds of your time.
Yeah, you know what?
Come on,
that's very valuable. So this is the luxury of working at WeWork. So all right, so we're back, and we were talking about humility or humble pie. There's really only two ways.
Keep expectations low. At least that's set expectations low, and outperform. There's a saying there that my mind's not grasping at the moment. But not everyone does that, and then you have to sleep in the bed that you make.
Truer words have not been spoken in this industry. So there's kind of one last topic that I wanted to touch on, and it's how do you think about valuations in a market where you really can't do fundamentals yet? Maybe you guys, as you think about like early stage assets or investing, either pre-launch or just some undervalued public assets, you might be able to get away with it. But in general, everything is about relative valuation right now. Would you agree?
For the most part.
How do you invest in a market like that?
For most market participants, things are relative valuation. So to just set the stage, valuation can be fundamental valuation, things like the net present value of cash flows, or MV equals PQ for the consumable transformables. Those are bottom-up models where you're starting with all these inputs that describe the system and ultimately culminate in a present value for all the future activity of this network or company or whatever it might be. Fundamental valuations are the holy grail that hopefully we get to in crypto. I mean, I'm going to say that we definitely get to in crypto, and note that it took equities 300 years really to arrive on consensus fundamental valuation techniques. I think if crypto does it in 30 years, I'd be happy. We're 10 years in, that would be an order of magnitude faster than the equity guys did. But what's hard about fundamental valuations is there's a lot of math that goes into it. And so, we need more and more experts focusing on this, taking it seriously. And then once theories are put out, the market actually has to come to consensus on those theories. And that's an even slower process because it's humans, it's our monkey brains achieving consensus. And so that's a long haul. I'm seeing great progress along it, but long haul. The other side is relative valuations, things like price to sales, price to equity. In crypto, it's the network value to transactions ratio, or network value to token value ratio, or the worst of them all, network value to network value, especially if you're not taking into consideration fully diluted supply, and you guys are more expert in this than anyone else. I think that the fact that network value is the most commonly used relative valuation metric in crypto is maybe one of the things that makes me most sad, because it's what allows some of the, say, less palatable actors in the crypto space to manipulate people, to list at really low prices with really high supplies, or things. I mean, we've all seen the, I don't want to use names, but this asset's at, half of a penny. Imagine if it gets to Bitcoin's price. Oh, but supply is 100,000 times greater than Bitcoin's price. So that scares me. But I think that, we use relative valuation techniques to compare, and this comes from my crypto training, or my equities training. We only use it to compare like for like assets, right? So if you're going to use NVT ratio, use it to compare Bitcoin, Decred, and Zcash, right? Those are cryptocurrencies, proof of work based for the most part, that have the same number of coins and are very similar. So, use it to compare there, and also use it to compare an asset to itself over time. And so that's very similar to equities, right? I wouldn't use price to sales to compare Netflix to IBM because they're totally different companies with different cost structures, different purposes in the world. And so that's, for example, why I wouldn't compare Bitcoin to Ethereum necessarily on network value to transactions ratio. I think that a good ratio that we recently created at Placeholder, which we need to formalize the math and numbers behind, and this is for smart contract platforms, is actually network value to token value. So Ethereum's network value divided by all of the value of all of the tokens that have been issued on top of Ethereum. And Ethereum trades at something like 2 times that value. All of its smart contract platforms are double to triple to 10x that valuation. And so that tells me Ethereum as a asset issuance and security platform is way undervalued relative to its peers. Or put another way, is providing way more utility to the world for the price that it trades at. And so I think that more standardization around better relative valuation metrics than just pure network value is very needed. It's a service that you guys provide for the space that I'm thankful for. And it's really having more and more intellectual watering pools like you guys, where everyone comes and says, okay, these are the standard relative valuation techniques. These are how these clusters of assets stack up against each other. Here are fundamental valuation techniques. This is the latest and greatest. Here's the work to be done, and we just keep iterating.
What do you think is the highest signal metric that you've come across?
So we don't trade, right?
I'm curious if our thinking lines up, because I have a very clear.
Well, it depends on the asset. It depends on the asset, and this is where, like, even with equity valuations, you can get very bespoke, right? Like ARC's models on Tesla are insanely deep and bespoke. I would say that for Bitcoin, the thing I watch more than anything else is the accumulation patterns. The hodl waves, or there's a few sell-side firms that have done a good job with this. And this is because I think of Bitcoin's primary utility to the world as a store of value. So I want to see how people are accumulating or selling the asset. NVT, Couch-Keynes NVT ratio, is good as well.
I'm surprised that you're still sticking with that one.
Still sticking with NVT. So I don't deny that NVT has problems, but I think that, you know, it does have signal. I do know. So Placeholder doesn't trade, but I do know firms that trade effectively with that signal. And the key with these signals, and again, well, this is unqualified opinions, so this is perfect. I'm not a trader, but I'm talking about trading. Having watched friends that are good traders, they're often looking for multiple signals to line up, right? You got NVT, you got accumulation patterns, you got the technicals and the charts, and when everything is saying go, 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 this is a great price, that's when you're entering that position. So it's hard to say there's a single thing. With Ethereum right now, you know, I've been looking at NVTV, which just screams that Ethereum's undervalued to me. Someone showed me recently a network value to gas consumer ratio, which I thought was fantastic, and also shows Ethereum coming into support. And then, you know, non-fundamentals, there are the price technicals, and technicals are so contentious, but you know what? Technicals work in the sense that they show you what the market's consensus is, right? If everyone is agreeing to technicals, look at Bitcoin's 200-week moving average. That was so reliable in this bear market, was so reliable in the past bear market. Will it be reliable in the bear market to come? I can't say for sure, but probably, right? And so this is where it's a combination of things that we end up using. With the smaller networks, what I'm looking for, so like we took a big position in Maker last year into this year. What I was watching is price of MKR was coming down as DAI outstanding was going up. And so DAI outstanding is a function of the utility of Maker's credit facility. And so what I'm always looking for, what I'd love to see, is if an asset price is cratering that I know has good cryptoeconomic fundamentals, if it's cratering while the utility of the network is going up. Because that basically to me shows, you know, the market is throwing this baby out with the bathwater. Fundamentals are improving. Eventually the market is going to catch up to that fact. And I want to start building a position now. We have to, when we build the positions in the public market, we do take into account technical indicators, because I don't want to get destroyed trying to catch a falling knife. Not that we've done a perfect job of it, but we've done a pretty good job. We also got fortunate with closing the fund January of 2018 and buying through this bear market. But you have to take all of these factors into consideration. And that's why it's hard for retail. It's not easy.
Yes.
It's not easy.
So the maybe the closing line, the punchline is, you should trust us with your money because we study this stuff all day.
Or just buy Bitcoin, Ether,
and just hold.
Decred and Zcash and hold.
Yeah. Well, Zcash, that's probably an entire other half hour that we could spend.
Maybe.
But I don't want to talk about it just because you and I think generally agree on this thesis, and I don't want it to be like a shill session.
Well, keep in mind to the listeners with Zcash that the first halving is upcoming October 2020, and the thing, people love to bash Zcash right now, but Zcash is going through its period of high inflation, right? And so this is where I watch network value, not price. And you've got buying opportunities right now and potentially into the halving. And then when the halving comes around, half of all Zcash that will ever be in existence will have been created.
If you're buying Hashgraph, Polkadot, Telegram when they come out at multi-billion-dollar valuations, and you're shitting on Zcash, you don't really understand inflation. is like the shorthand.
Yeah.
But it'll be fascinating to watch that. I think there will be a reversal, but again, we're not going to make too many price predictions. Certainly not buying
investment advice. These are unqualified opinions.
Yes, and Chris and I have both taken turns getting our faces blown off in this market.
Everyone gets it wrong.
And so,
here's maybe a closing thought. Everyone gets stuff wrong. Personally and for everyone else, I think we do better when we admit when we were wrong, because then we learn, as opposed to putting up the ego and being like, no, I was never wrong. I'm never going to learn. You can't help but get it wrong in such an asset space.
You know what's interesting? I think it's very easy if you just get into the habit of kind of deconstructing your past performance and decisions. It may be the easiest way to start admitting that you're wrong is to recognize when you were wrong for the right reasons, right? Where the thesis was correct, but the probabilities, you had the probabilities wrong, or some other event that you didn't really foresee ended up, kind of dominating the investment thesis. And a perfect example of this for me is actually Ethereum. I was wrong for several years, but I think for the right reasons. I didn't buy the token sale. I'm glad I didn't, because if I had, I would have sold it anyway. If anyone knew how dysfunctional the early Ethereum community was at the Ethereum Foundation, there's going to be a book or multiple books about it out soon, I'm sure. But anyone with insider knowledge of how dysfunctional it was crazy, right? So there's no way that you would have rationally. There was a situation where you may have had too much information in some cases with these assets. And then frankly, I don't think the thesis changed until the ICO market, because that was the first time that Ethereum became money, versus this world computer gas that was very, novel, but not compelling as an asset. But once you kind of open up the door to, okay, I know I was wrong, here's why, it makes it easier to say, here's what I was thinking at the time, and these like sub-theses were the things that were really wrong, versus just, I'm an idiot. Right? So if you're really stubborn and like ego-driven, it's going to be tough to ever just say like, I'm a total idiot, like I should have seen this, and this. But it becomes much easier if you're like, I had 90% of it right, but the linchpin of the thesis, I really got wrapped on that, right? And so easing into that, right? Yeah.
Post-processing is important. And you raised another key thing. Everyone talks about, I should have bought Bitcoin at X. Very few people talk about how hard it is to hold that Bitcoin or to hold that Ether or whatever it might be. And so it's this idea of, Joel has a saying that he got, I think, from Marcus Aurelius, of it doesn't matter what you do, you're going to regret it anyway. And often we make decisions and then we go on this path and then we look over at this other path and we're like, I should have made that decision. But what we don't realize is if we went that path, we'd be looking over at this path saying, I should have made that decision. And so, I've bought things at the wrong time, I've sold things at the wrong time, I've made tons of mistakes, but on the whole, I'm up, right? And I'm up from a fiscal perspective, but much more importantly, from an intellectual perspective, from the community perspective, from all these things.
And it's helpful, especially to hear from guys like you, Chris, because one of my recommendations, and this applies to me, it applies to you, it applies to Nick Carter, Kai Samani, so many young, non-technical folks that have gotten into the industry and have still done very well. There's I think, a misconception that you need to be a developer to make any inroads. Almost all of them have written relentlessly and expose themselves to being wrong in a public setting. And because the industry, especially social media, is so brutal, it's like iron sharpens iron. If you can cut all the kind of bullshit and hurt feelings aside, and you can just grow a pair or like picking up your skin, then it becomes probably the most relentless learning environment that you could possibly have.
It is. It has its own drawbacks.
And you're losing money, so it's like anytime you're wrong, you're like adding insult to injury, which doubly helps you in terms of the learning process.
So I know we could go on forever, and we probably have to call it here, but So someone asked me recently if I could change something about crypto, what would it be? And I said the tribalism. And we talked about it from the experimentation standpoint, but I think also from the feedback standpoint. Like, tell people when they're wrong, but do it with class. And Decred is actually a good example of this. For the most part, their debates do not devolve into name calling or that really toxic stuff. Occasionally, but more rarely. And I think it all comes from the top. And so, more networks, more teams, I hope will create kind of these candid but kind environments. Right now we have candid but kind of mean. And I don't want to exist in a kind of mean world in the future.
I think the world's just kind of mean, but
Maybe.
We'll try to keep things nice here anyway. Chris Burniske at Placeholder, at Burniske on Twitter. When he does tweet, they're usually to some pretty cogent points. So follow Placeholder. Probably one of the portfolios that if I were running capital, I'd want to mimic just in terms of the portfolio selection. I just tend to like many of the projects you guys have backed.
Thank you.
But and I think it's because you and I share the value-oriented investor thesis.
We've been doing this for a long time.
Exactly. So thank you again, Chris, and everybody. Hope you enjoyed this record-setting unqualified opinions, at least in terms of length. I'm sure it's probably going to be very well in terms of eyeballs and listens as well. Until tomorrow, where we have another great show coming up. Thank you for joining us, and until next time, peace.